The miracle of simple allocation. Why basic diversification often outperforms complexity. In investing, complexity is often mistaken for intelligence. Yet decades of research suggest a powerful counterintuitive truth. Simple asset allocation frequently beats sophisticated optimization. Not because it is flashy, but because it is durable. 1. The power of diversification. The foundation of modern diversification was formalized by Harry Markowitz through modern portfolio theory. His key insight: it's not individual asset returns that matter most. It's how assets interact. Combining imperfectly correlated assets reduces volatility, improves risk-adjusted return, smooths drawdowns. And this does not require complexity. Even broad allocations across equities and bonds can significantly reduce portfolio instability. 2. Equal weighting versus optimization. Studies have shown that simple equal-weighted portfolios often perform competitively with optimized ones. A well-known example is the 1/N rule, equally dividing capital across N assets. Research by Victor de Miguel and colleagues demonstrated that naive diversification frequently matches or exceeds optimized portfolios when out-of-sample uncertainty is considered. Why? Because optimization depends on fragile assumptions about future returns, correlations, volatility. Simple allocation avoids overfitting. 3. Behavioral stability. Complex strategies demand frequent monitoring, tactical adjustments, constant forecasting. This increases decision fatigue, emotional intervention, strategy drift. Simple allocation reduces noise. Fewer decisions, fewer mistakes. Consistency becomes easier. 4. Broad market exposure works. Investors holding diversified index exposure, such as funds tracking the S&P 500, have historically benefited from long-term economic growth without the need for constant asset rotation. Over long horizons, participation in productive assets has been more important than tactical precision. 5. The cost advantage. Simple allocation often means fewer trades, lower transaction costs, reduced tax drag. Cost control is one of the most reliable predictors of long-term outperformance. Even legendary investors like Warren Buffett have recommended low-cost index-based strategies for most investors, particularly through vehicles associated with Berkshire Hathaway shareholder communications. Simplicity reduces friction. 6. Robustness over precision. Complex strategies aim for precision. Simple allocation aims for robustness. Robust systems survive regime shifts, adapt to uncertainty, avoid dependence on perfect forecasts. Markets are unpredictable. Robustness beats elegance. 7. Compounding needs stability. Compounding works best when drawdowns are manageable, investors stay disciplined, emotional interference is minimized. Simple allocation enhances staying power. Staying power enhances compounding. The structural advantage of simplicity. Simple allocation reduces model risk, lowers behavioral risk, controls cost risk, limits forecasting risk. It is not intellectually flashy. It is operationally powerful. Final insight. The miracle of simple allocation is not that it guarantees extraordinary returns. It is that it reliably supports long-term compounding without demanding perfect foresight. In uncertain markets, clarity often outperforms complexity. And sometimes, the simplest structure is the most resilient one.